Good morning. You're watching the market right on ET now, and what an action-packed Thursday night it has been. So dramatic all through, pretty much. And the most dramatic of it all was really the public meltdown that you saw between Trump and Musk alliance, and that has officially imploded on social media. The US president and Tesla CEO traded blistering insults on their platforms last evening, with Trump actually threatening to axe Musk's government contracts and Musk firing back, claiming that Trump wouldn't have won this election without his backing. In fact, the fallout followed a big spat over the big beautiful tax cuts bill as well, and quickly spiraled from digs about Musk's black eye to Trump yanking support for Musk's NASA pick. Musk even alluded to Trump's name in the Epstein-linked documents and backed impeachment calls as well. And just weeks ago, to think of it, he was the top advisor and Oval Office regular. But today, Musk is hinting at launching a centrist political party. Meanwhile, Tesla shares have slid and SpaceX rivals have soared. In fact, Tesla lost more than $150 billion in market cap in a single session last evening. The much talked about bromance seems to be over for now at least, but the battle may have just begun. And that wasn't it. Trump had a very busy last evening. A call was with President Xi Jinping as well.
Well, certainly, Aisha, indeed a busy evening for Donald Trump with the tweets and the phone calls, because as Trump and Xi Jinping agreed to restart the stalled trade talks following a 90-minute call focused largely on tariffs and rare earth minerals, Trump hails the discussions as very good, with US trade officials set to meet their Chinese counterparts soon. The talks come amid a tense trade war and fresh US export curbs on Chinese ships, where Beijing's pushback on student visa restrictions and semiconductor warnings has only deepened the rift. Still, Trump says that the call ended positively and said that Xi invited him and Melania to visit China, an offer he has accepted. Let's go across and listen into him as well.
We had a very good talk, and we've straightened out any complexity. It's very complex stuff, and we straightened it out. The agreement was we're going to have Scott and Howard and Jameson will be going and meeting with their top people and continue it forward. But no, I think we have everything. I think we're in very good shape with China and the trade deal. We have a deal with China, as you know, but we were straightening out some of the points, having to do mostly with rare earth, magnets, and some other things.
So those reduced trade tariff rates, they remain in effect?
Yeah, we have the deal. I mean, we've had a deal. We announced the deal. And we'll be, I guess you could say, I wouldn't even say finalizing it up, Scott. I would say we have a deal, and we're going to just make sure that everybody understands what the deal is. Okay? We had a really good conversation. By the way, he invited me to China, and I invited him here. We both accepted. So I'll be going there with the First Lady at a certain point, and he'll be coming here, hopefully, with the First Lady of China.
So much has happened over the course of the last 10 hours or so, last 8 to 10 hours. You have geopolitical relations between China and US improving, according to Trump. And then you have the whole meltdown saga between Trump and Musk as well. In the light of all of this, the US markets have seen a little bit of a slip coming in yesterday, where Dow has been slightly resilient to 0.2% cut coming in, but it's the S&P and the Nasdaq that have taken a steeper fall, because S&P was lower by 0.5% and Nasdaq lower by 0.8%. You have the Russell Small Cap Index that's on its way to an 8th winning week out of the last 9, so at least that is looking positive. And if the Friday's trading session for US goes well, all of these three major indices will be ending the week with in the green, and this will be the second consecutive week where they're ending in the green. But having said that, if you take a look at what the futures are up to, you have flat moves coming in on the futures. Nasdaq absolutely flat, but Dow and S&P in the green at least. So that was on the US front. Also, the focus was on US unemployment claims, the jobless claims numbers that have come. They were much ahead of street expectations at an 8-month high. So that is something that has weighed on the US markets. Other than that, Europe was pretty okay, not much happening over there. Flattish moves coming in. DAX, CAC, FTSE, Stock 600 all absolutely flat. So not much happening over there. Asia at the moment seems to be rather tempered as well, but it's only the Nikkei that is outperforming the market, 0.5% uptick coming in. Other than that, you have Hang Seng taking a knock of 0.3%, but Shanghai and Australian markets seem absolutely flat right now. So that's what the global markets have shaped up like yesterday, and that's what Asia is doing right now.
Oh, yeah, absolutely. And let's now shift focus to the domestic cues. Just before that, I want to see what the Nifty implied open is settling in at. We'll just come up for you at the bottom of your screens. But yes, all eyes will also be on the RBI today. The big question is, will the June monetary policy bring a third consecutive rate cut or not? Remember, both in the months of Feb as well as April, you've seen the RBI cut rates by about almost 25 basis points. So will it be another 25 again? Because most analysts on the street are pricing in another 25 after today's outcome too. But who better than Sonal Verma, Managing Director and Chief Economist at Nomura, joining in today to talk about exactly that. Sonal, hi, good morning. Good to have you on the show. What's it going to be, Sonal, today? 25 bips, or do you think in one go they could perhaps cut down to 50?
Well, we think it is likely to be a 25 basis point cut. I mean, the MPC has delivered 50 already, so I think steady as it goes would be a better outcome today.
Right. Hi, Sonal. Good morning. This is Shrishti also joining in. But other than the rate cut, the street is also looking for the commentary and some changes maybe in the projections when it comes to inflation. Give us some sense. What are you penciling in, given the fact that the GDP data so far isn't that disappointing, and the recent print was also better than what the street was penciling in?
Yeah, absolutely. So if we sort of look at what has happened in the last 2 months, the growth numbers have come in, I would say, in line with the RBI's expectations, although better than street expectations, whereas we've seen a bigger than expected drop in food prices. So incorporating both those trends, our view is the RBI is likely to retain its FY26 GDP growth projection of 6.5%, whereas the CPI inflation projection, which they currently have at 4% in FY26, that we think should get revised down a lot more. Our own expectation of the RBI's forecast is about 50 basis point downward revision to around 3.5%. So FY26 being a year where inflation undershoots the 4% target should be the message.
And if you talk about your GDP forecast for FY26, you've hiked that from 5.8 to 6.2. Now, recently we've seen very robust set of IIP numbers coming in, much ahead of street expectations. Overall, FY24, FY25 GDP data has also been a beat versus street estimates. Where do you see the overall economy headed? Because this year we are also expecting good monsoon. So do you believe that our macroeconomics look rather stable right now?
Yeah, I do think India's macros look quite stable in the context of, relatively our growth is resilient. We have low inflation, fiscal current account deficits are well managed. So I do think macros are quite stable. Our own projection for FY26 GDP growth is 6.2%. So we do think FY26 will be a softer year than FY25, where we ended at 6.5%. And a few reasons for that. We are seeing, I would say, both positives and negative factors at play. The positives clearly being, as you mentioned, good monsoons supporting rural consumption. India is seeing some benefit from trade diversion. Oil prices are low. Inflation is low. These are clearly the positives. On the other side, though, we are also seeing a moderation in consumer credit growth, urban salary growth, which we think will impinge on urban consumption. The private capex side still remains very soft for a variety of reasons. And across Asia, what we've seen is exports are holding up partly because there's been a lot of front loading of demand ahead of tariff. So there will be some payback effect later on in the year. And we do expect global trade to slow down. So when we put all of those together, I think for India, there are positives and negatives. On the whole, we think 6.2 is more likely in FY26.
What do you think is going to be the commentary on liquidity, and how do you think the central bank is going to enable, liquidity is a flush with banks and faster transmission, of course?
I think from the RBI's standpoint, they have done a great job in infusing liquidity in the last few months. And for now, it does seem like they have done enough. And so we don't think there will be any further action today. However, the communication on liquidity will still be important, and re-emphasizing and reiterating what was stated the last time, which is that the RBI will keep banking system liquidity in a surplus of around 1% of NDTL. I think that communication should still come through. Now, we know that the actual transmission from liquidity to bank funding costs coming down to that leading to lower lending rates typically takes time. And so the transmission process has started, it will continue. Meanwhile, it's just important from the central bank's perspective to retain and communicate on liquidity staying in a surplus. I think the rest will happen over a period of time.
With that, Sonal, give us some sense that how do you see the whole capex numbers going ahead? Because for now, post the budget as well, we have seen the government spending holding up. But what's your sense for the second half of this fiscal, and along with that, how can we expect to see the private participation?
Our baseline view is the public capex side will remain strong, and whatever the government has budgeted, that will get executed. Of course, what we've seen so far in April has been a fairly sharp jump in central government capex. It was up over 60% on a year-over-year basis in April. So there is some sort of front loading of capex we are seeing, which makes sense. So that we think will continue. On the private side, things are a bit more complex. Capacity utilization is still in the mid-70s, and we've seen a rush of imports from China, which could partly be a reason why capacity utilization is low and uncertainty is high. So typically, it's not a macro environment where we see new machinery and equipment capex happen. So we think, it's going to be more public capex driven, and private is likely to remain soft in FY26.
Sonal, before we let you go, just want to get your sense on where the RBI is seeing our GDP headed, because if RBI is likely to retain their FY25 GDP predictions, then why are on one hand they increasing their own estimate going ahead for the GDP? So help us understand what's happening on this front.
So we are expecting the RBI to retain its estimate of 6.5, not expecting them to change that. And I think what we will be looking for is really the commentary in terms of the drivers of this growth. So to what extent domestic demand can offset the expected moderation on the exports and the external side, given uncertainty is quite high there. I think other than that, I think the important question is around 6.5% enough relative to what our longer term potential and aspiration is with respect to creating more jobs. And I think that has been a big focus. And it does appear, looking at the whole set of macro data, including things like, very benign core inflation, that the actual growth right now is below what our potential is. So the numbers are good, but in terms of the breadth of the growth recovery, it's not where we want it to be.
Sonal, that's precisely what I meant to ask you, because if you believe that the underlying growth is still below our potential, then what would be the reason behind you increasing your GDP estimate to 6.2% from 5.8 earlier?
Yeah, the fourth quarter numbers were much better than expected at 7. So fourth quarter FY25 at 7.4%. I mean, it was driven by a few technical factors, which we can go into if you like. But the starting point was much better than expected. And the lower inflation, so for FY26, we're expecting average CPI inflation at 3.3%. so significantly below the 4% target. Now, low inflation also tends to be a tailwind for India, particularly for from a private consumption side. Real disposable incomes go up when inflation goes down, so that's a positive that we have incorporated. And third, I think amongst the various nations that are trying to strike a deal with the US, we do think India is one of the front runners. So while the global environment is fairly adverse, India can relatively do well in some of the low-end to mid-tech manufacturing segments and get some market share. So we've incorporated these things in our new forecast.
Sonal, great having you on the show today. Thank you so much for your time. Okay, that's the word coming in on the state of the Indian economy with Sonal Verma from Nomura. But let's shift back to what's happening with the global markets, because President Trump had a phone call with China President Xi. Not much details coming in, but what really stood out was his very ugly spat with Elon Musk. What the markets have done overnight, there's been quite a crack, both for the S&P 500 index or for that matter, the NASDAQ as well. Almost a 1% fall coming in. The dollar index is now down to 98.70. The 10-year yield, that saw an uptick of about almost 4 basis points. Brent oil has seen an uptick, as have gold and silver. But Kanishka is here to walk us through what the global commentary has been overnight. Kanishka?
That's right. First of all, a very good morning to you. Now, apart from the spat that Donald Trump and Elon Musk had and also his conversation with Xi Jinping, there's a lot of central bank and political policy commentary that's shaping the global market narrative. Now, ECB President Christine Lagarde, she confirmed that with that rate cut announced, ECB is nearing the end of that tightening of the rate cycle. However, she's flagged caution, citing weaker near-term growth perspective and also warned that higher tariffs and a strong euro could make European exports more challenging. Still, she's struck an optimistic tone when it comes to, saying investors see value and remain confident in Europe. Now, apart from that, in the US, we had Government Secretary Howard Lutnick, who has laid out ambitious goals under a potential second Trump administration. Now, stating that Trump wants the entire chip supply chain in the US. That's the aim is 5 million wafers produced domestically and 5 million American workers trained for semiconductor manufacturing. On the monetary policy front, we had Fed Governor Adriana Kugler, who highlighted the upside risks to inflation, warning that the Fed should should maintain current rates if inflation remains sticky and even if growth and jobs slow down. Apart from that, Kansas City Fed President Jeff Schmidt cautioned that tariffs will likely push prices up, though the impact may unfold only gradually. And finally, big words of praise for India from the World Economic Forum chief Bob Brent, who was called India the global economy's bright spot. Now, he's highlighted that India's 7.5% growth in the last quarter exceeded expectations, and that if this momentum continues, the country could become the world's 4th largest. In fact, this year itself, overtaking Japan and hitting that $5 trillion mark.
Okay, Kanishka, we'll leave it at that, and let's get back to discussing what all of this could actually imply for the global markets. We've got Ed Yardini joining in on the show right now. Ed, hi, good morning. Good to have you on the show. And here we thought we'll start talking about Trump and Xi, but I think the bigger headline is what's happening between Trump as well as Musk, and that's clearly getting ugly. I mean, now Musk calling out for Trump's impeachment. Where do you think this spat is headed?
Well, it's certainly not a happy development, though I think there were some commentators that figure that such powerful men with the big egos that they both have, that the bromance wouldn't last very long, and those forecasts turned out to be right. Now, you can never know exactly how these things develop. For all we know, in a month or two, all will be forgiven, and we'll be moving on and see them shaking hands. But right now, Musk sounds like he's really talking about significantly reducing his support for Democrats in the Republican midterm elections next year. And he's even talking about a centrist party. So it's a very fluid situation. I mean, Trump is obviously extremely powerful as the president of the United States, but Musk clearly also has a tremendous impact, as evidenced by the fact that we're talking about him, and we're talking about that before we're talking about the conversation between Trump and Xi, which I think actually is obviously more important. And from what I gather, they both agreed to keep talking. And Trump made it sound like the deal is still on, whatever that means. But I think the concerns has been about rare earth minerals, I should say. And I don't know. We'll see. We need more detail to see whether something has been ironed out in that regard.
Hi Ed, this is Shrishti. But Ed, overnight we have seen a big slump in Tesla stock as well. It's been a 14% decline amidst all the conversations that these two were having. Along with that, if the spending and the tax bill goes through, it can have a negative impact on Tesla, which is already dealing with a sales decline in some of the other geographies. What's your sense on Tesla as a stock? Do you believe that more of such fall one can actually expect?
Well, it just all demonstrates that the head of a company really has to focus on the best interests of the shareholders. Musk, because of his unusual power in Tesla and a few of the other companies, feels as though he can do more than one thing at the same time. And I think shareholders are going to be quite annoyed, if not angry, about Musk not focusing just on Tesla. And he said that he was leaving the Doge committee to focus on Tesla, and all of a sudden he's, writing all sorts of fairly nasty comments about on the political side. So he's got to decide what he wants to do. But I think Tesla is going to be a one-off case, obviously determined by the rhetoric coming out of Musk and how Trump responds to it. And the reality is it's not going to have any impact on the trade negotiations. It's not going to have any impact, I don't think, on the big, beautiful bill, which obviously Musk thinks is a big, ugly bill. And would like to kill the bill. But I don't think he's got enough influence to do that. And I think politicians will want to pass the bill, if nothing else, because it maintains the tax cuts that were imposed in 2017. Without that, we're going to have a major tax increase, which could really hurt the economy. And that's the last thing the Republicans want, is anything that'll hurt the economy as they approach the midterm elections at the end of next year.
Okay, Ed, hi, this is Snehi also joining in. Just wanted to shift focus from the Trump-Musk dynamic to the Trump-Xi Jinping dynamic, then everything that's been happening on that front. While we don't have a lot of details out of this almost 90-minute call, what do you think the impact of this very slow negotiation between these two countries could have on the market, especially on sectors that are heavily reliant on this entire US-China trade dynamic?
Well, there's obviously a cultural divide between the way China likes to do things and the way the United States likes to do things. And certainly with President Trump likes to negotiate, likes to do deals, and likes to kind of do it, person to person, leader to leader. And that's not the way the Chinese much prefer to have a delegation of experts on trade negotiate. And 90 days is not a period. Nobody believes that you can negotiate a trade treaty in 90 days, let alone implement a trade treaty. All you can get in 90 days is an agreement to keep talking. All you can really do is get maybe a framework of how future talks should go. I think at some point here, President Trump is simply going to declare victory, declare that there's enough of an understanding of where negotiations can go that he'll let the decisions be made and negotiated by delegations from China and the United States. But it's not going to be an easy negotiations. The Chinese aren't going to make it easy for Trump, and Trump has sort of cornered himself because he doesn't have the luxury of time, given that the midterm elections are coming. Also, the lower court has ruled that Trump doesn't even have the constitutional authority to do what he's done on the trade side. That's been stayed by an appeals court, but this may go up to the Supreme Court, and it's possible that even the Supreme Court will rule that Trump declared a crisis when there isn't a crisis, and took on powers that he really doesn't have if there isn't, in fact, a crisis.
Indeed. But Ed, good chatting with you today. Thanks for your take on all that's happening between Trump and Xi and Trump and Musk. But let's move on to our markets. The range-bound move continues. While it was a little different yesterday, the markets did attempt to scale up, and we finally closed in with that 0.5% gain. Right now, once again, it seems like we're headed in for a very, very flat start. Kunal is here in the studios. Kunal, hi, morning. What's the market texture looking like?
Same old. I think last 2 weeks.
Nothing has changed.
Nothing has changed. I think except for a few sectors and few stocks, one-off, which have participated on the upside, there's hardly any major change in the market texture. The only good part which you're seeing for individual stocks is, like, for example, yesterday Reliance made a very good comeback, coming closer to that 1420 breakout and then 1440-50 levels for itself. You saw some traces of large cap names like HDFC Bank showing signs of a potential comeback. So I think all of these possible large cap signs, if they manage to come back, as a unit or as a group, that I believe could be a catalyst factor for the markets to break past about this dull, boring, kind of a 500 points range for the index. And the other behavior which you are also looking out for is that in the last 2 days, there have been mild reduction in the open interest for the Nifty futures, just about some 1.5 lakh in the Nifty futures on a daily basis over the last 2 days. So that could probably be an indication that maybe we are looking at a point where the long traders are just about taking some bit of time out from the markets and waiting for the event to pass out the RBI policy. But I think post that, if you manage to see even a slight bit of addition on the open interest front, I believe that could probably be a good enough indicator that the markets are ready for a breakout. So net, so far the view remains that the indices are trading into a range, but the bias still remains bullish.
So in this bias, Kunal, what do you think is going to charge up? Like you said, Reliance already is participating. Yesterday, ICICI Bank was holding out, and then smaller weightage names like Eternal, Trent as well are propping up once again. So what do you think if the market is going to scale up from here? What's going to be the contribution chart?
So in terms of contribution chart, I would believe Reliance should be one of the top contenders in terms of a breakout, because with the concern with the other sectors, for example, banking, private sector banking names, even the PSU banking major like SBI, is that you don't have a cohesive move on the upside. So Reliance, I think, could be the top contender in terms of a breakout. The stock has already consolidated for the last 2 or 3 weeks, so which means that there could be a very strong chance that the stock may start to look a lot more attractive. You've seen already defense stocks looking charged up. NBFC pocket, that's a space which I believe could probably start to look a little bit more attractive, especially I think if the markets get that kind of a rate cut expectation. So maybe the likes of Bajaj Finance, Finserv, they could also start to look a lot more attractive.
Okay, and Kunal, amid a range-bound market like this, where are you placing your bets? What's looking attractive this morning?
So I'm concentrating on 2 stocks which are highlighted in terms of a potential breakout. L&T Finance apparently yesterday managed to come back into almost like a 3-month or a 6-month breakout, breaking past about that 180 major resistance barrier. So looks extremely attractive at current levels. 188 could be a target which I will place for L&T Finance, and stop loss could be kept at 178. And the second would be about Hindustan Zinc. This could be a very interesting chart, because after almost like a 50% correction for Hindustan Zinc over the last 9 months, 12 months, the stock has made a very strong comeback. I believe that this could be a potential strong swing breakout. So we'd look out for 530 as a target, stop loss at 484.
All right, so those are the top calls coming in from Kunal. But the RBI could fire its third rate cut for FY25 today as the inflation cools and demand slows down. Now, with the growth outlook still blurry, and a system flush with liquidity. A 25 basis points of cut is widely expected, with a total of up to 75 bips expected by economists in the current cycle. Anurag Shah joins in to tell us what to expect from the RBI meet. Anurag.
Second MPC meeting of this fiscal, and there is a broader consensus among economists and market participants about 25 basis point rate cut to be announced today. And if that happens, that it will be a third consecutive rate cut of 25 basis point by RBI. Market will be looking for growth outlook and the CPI inflation outlook by RBI, because in last policy we have seen that RBI reduced growth outlook for FY26 to 6.5% due to the global growth tension. So market will be looking on that, and there is also consensus among market participants and economists that the stance will be, RBI will be continuing accommodative stance only, because in last policy RBI changed the stance from neutral to accommodative, and going ahead the accommodative stance will continue. There are few participants, small in numbers, are also expecting that RBI or MPC may surprise with a 50 basis point rate cut also, because inflation numbers are giving comfort to RBI. The April CPI inflation number is below the RBI target of 4%. So if that happens, that will be a big bonanza for market, and there will be some announcement. Participants are also expecting related to the liquidity, although a lot of announcement made by RBI in last few months, but market is looking for few more announcements. So these are the main expectations, and we'll be looking for a 10 o'clock announcement by RBI Governor Sanjay Malhotra.
Okay, well, let's also go across and listen into market experts. You have a word coming in from Pranjal Bhandari as well as Upasna Chachra. Let's go across and listen into what they are expecting when it comes to the RBI's announcement today.
GDP was very high, 7.4%. GVA, which I think better picks up, where activity is, was 6.8. I think that's more believable. But even GVA was a bit higher than it has been in the last couple of quarters, although lower than where it was a year ago. So there's good and bad news. Things have improved from, say, the September quarter or the December quarter, but they are not as great as where they were exactly a year ago. A year ago, we were between 7.5% growth. Now, what created this slight uptick in March? As you said, some of them were like one-off. The fact that government spending had been a little weak, right, through the election period in July last year, and then even in December quarter, it hadn't really picked up. So a lot of the pickup in both central government and state government spending happened in the March quarter. So that helped, raise numbers, and we may not see the same type of increase in the next couple of quarters.
Looking at the domestic growth and inflation trailing data, and also the outlook on the monetary policy side, we do have the view that it will remain decisively on the easing side. We've already seen RBI take those steps. Change of stance to accommodative cut, two rate cuts have already come through. RBI has added a lot of durable liquidity in the system, and I think that will continue. So with the inflation outlook remaining benign, as I mentioned, you'll see readings closer to say 3.5% in the next few months. And even if you look at 1 year forward inflation forecast, they'll be pretty close to 4%. So, RBI will be comfortable that inflation is durably aligning with its medium-term target of 4%.
Co-presented by Hyundai. Book your Hyundai car today.
All right, back to the markets right here on ET now. Well, yes, the GIFT Nifty is indicating a flat start for ourselves, but an important day for the Indian markets, as 25 basis point is what the markets are already pricing in when it comes to the MPC outcome. But indeed, a lot of stocks will be in focus on the back of the news flow. So let's go across to my colleague Varun, who is standing by to give us that list. Good morning, Varun. Take it away.
Good morning, Srishti. So let me start with ADA because the QIP for the company has opened and the floor price for the QIP is 173 rupees 83 paisa. Now that's a discount of 1.5% to yesterday's close. Ashoka Buildcon, the company has received letter of intent from Motor Vehicles Department, Maharashtra for various circles, and the project is spanning for 10 years and the estimated value for the project is 1387 crores. Now keep an eye on Praj Industries because one of Paraguay's foremost renewable energy company has selected the company Praj Industries for its next major project of a fully integrated refinery project. So that's the reason you need to keep an eye on Praj Industries as well. Power Grid, the company has commissioned a transmission network expansion project in Gujarat. Coal India and Indian Port, Railway and Ropeway Corporation, they have executed a non-binding MOU at Kolkata, and this is for the development of rail infrastructure for Coal India and also its subsidiaries. And last but not the least, keep an eye on Emphasis because the company has launched Center of Excellence for Financial Services in Argentina.
Thanks for taking us through that list of stocks. Lots of stocks going to be in focus today. Let's welcome on board Sandeep Sabharwal to help us make sense of the markets and some of these stocks. Hi Sandeep, morning and thanks for joining us. But before we get to the news flow on the stocks, talk about the markets and the sector, give me a sense of what you are penciling in when it comes to the RBI policy, because largely the street is penciling in a 25 bips cut. Do you believe that this is already priced in the market momentum today? And if this is announced, can we expect this to be the leg up that could get markets out of this range? Or do you believe that this is factored in and not much can be done about the markets today?
So the markets will come out of a range eventually, I think, because we saw significant rallies right from 21,800 to above 25,000 in a very short period of time. So there's a phase of consolidation which is going on, which is natural in the market and which we shouldn't be so bothered about because only phases of consolidation can help us buy into some stocks which we might like if they correct or consolidate, etc. Otherwise, a straight line market up move benefits no one and eventually leads to big frenzy building up and then markets correcting sharply. Now, on the monetary policy, I think they'll tread the path of 25 basis points only, although there's a significant case for a 50 basis point cut, given the fact that retail inflation could be ranged between 2.75 to 3.25% for the foreseeable future. And as such, even after a 25 basis point cut at 5.75%, Indian real rates will remain among the highest in the world. So I think the real rates need to come down faster. So it's unlikely they'll take this step of 50 basis points because typically Indian MPC, RBI tend to move conservatively. But if they do, I think it will be a positive development. If not, I think we'll get another cut in August.
All right, but Sandeep, banks vis-a-vis NBFCs, which is looking better to you right now? Because in this rate cut cycle, what we have seen and what is the expectation ahead? Believe that this another rate cut could put some pressure to the NIMs for the banking space, but indeed could be very good for the NBFCs.
So what's happening now that after the rate cycle, cut cycle has started, now for banks it's coming to a stage where because we have had previous cuts, so we are coming to a stage where bank NIMs will start getting adjusted. So I think although there will be a near-term, short-term impact, but I think longer term it improves the prospects because lower interest rates lead to better asset quality, and better asset quality is always better than having a 5 basis point extra margin. But you rightly said, and that NBFCs tend to benefit much more in a rate cut cycle because banks have CASA deposits which have more or less fixed rates, which can vary maybe a little bit here or there. But NBFCs tend to be more bulk borrowers, and they, with a lot of NBFCs having loans which are fixed rate. So a rate cut cycle typically would benefit NBFCs much more. So directionally, some NBFCs, like the high quality ones, could outperform banks. But overall, for banks also, it's not bad at all.
Okay, let's address the flavor of the market nowadays, and it's really been a block deal party which is clearly on in full swing, and it's Bajaj Finserv now, which is going to be the latest likely addition today. We understand that promoters are likely to sell nearly about 2% stake, and all eyes will be on that big deal after blocks on Tata Tech, Alchem, ABFRL, Ola, Yes Bank. Sharad is here to tell us more about the Bajaj Finserv block. Sharad?
Well, a slew of block deals happening this week. First, it's likely that Bajaj Finserv, the block deal likely today, almost promoters would be selling 1.9% stake, coming into almost 5,828 odd crore rupees. Now, interestingly, the floor price is at 1,880 rupees per share, indicating a 3.3% discount. The promoters roughly have 61% stake as per the March shareholding pattern in 2025. Now, other key blocks which happened this week: Tata Tech TPG sold 2% stake worth 635 crore rupees, and that was a complete exit. Alchem Labs promoter sold 1.42% stake worth 825 crore rupees, and the promoter holding was roughly 55% in the March quarter. ABFRL, there's a complete exit coming in from Walmart owned Flipkart. They're selling entire 6% stake worth 600 crore rupees. And interestingly, Ola Electric Hyundai took an entire exit sale of almost 2.47% stake, with a deal coming into 550 crore of value. And lastly, Yes Bank, important stake sale by Carlyle, 2.6% stake worth 1775 crore rupees. And last time also in May 2024, they had sold almost a similar amount to almost 2% stake worth 1440 crore rupees. So these are the important block deals happening in Dalal Street this week.
Yes, block deals and more block deals. But let's try and understand what else has been happening in the markets in terms of a trend. It's really been about, Eternal, Trend, Swiggy, all these names have been playing a catch-up. Kunal, within this entire large retail e-com space, what's looking like the most attractive stock right now? Is it Trend, is it Eternal, or Swiggy? I know you don't have too much data on Swiggy though.
Yeah, so Swiggy a little bit of less data, and even within that also, it's not that there's been a major movement of trend into the stock for Swiggy. It's largely been a stock which has just fluctuated in a band of, I think, 300 to 365, 375 thereabouts, over the near to medium term. But I think on the other two names, Trent and Eternal both had their share of underperformance. There was a point where I think Trent had fallen below the 5,000 mark just recently in the last 1 or 2 months on the back of some negative news flow. And in the last 1 or 2 months post that, the stock is just trying to recuperate from the losses the stock had seen. So that there was a major gap which was there for Trent on the chart, which is around the 5,700 mark, 600 levels. That gap is just about getting filled for the stock. So as of now, it's just come back into a recovery of the last major sell-off the stock had shown. Eternal, on the other hand, the move which we're seeing in the last couple of days specifically, I think is a strong indication that maybe the extreme worst could be behind to the stock price. There was a point when the stock post results, I think a couple of quarters back, had fallen from 250 levels, 260 levels to almost 200 or sub 200 mark. But the way the stock has managed to recover and come back above that 250 levels indicates that this could probably be a potential reversal on the positive side for Eternal. So out of the two names, if I have to pick and choose, Eternal would be something which I'll be bullish on.
Okay, so Eternal is Kunal's favorite pick from the entire consumption space. But Kunal, what are you making of Bajaj Finserv and Bajaj Finance, the Bajaj twins? Because all eyes are going to be on Bajaj Finserv today on the back of that expected block deal. While the last 6 months have been pretty good for both of these stocks on the charts, last 1 month or so has been absolutely lackluster. Are you spotting any breakout on the charts anytime soon for the Bajaj twins?
So, there could be two parts to it, Sneh. So, one would be that, the stock has seen multiple times in the recent history also these kind of, block deals. And the way the stock has managed to absorb that, I think is commendable because, post that, maybe in a matter of a couple of weeks, the stock makes a very strong comeback as such. So, the overall texture of the market, assuming if that remains to be buoyant or, even at current levels, I would probably believe that Bajaj Finserv Finance could make a comeback. The other way to look out for is that the NBFC pocket, many of the mid-cap names of the NBFC stocks, are trying to make play a catch-up or at least head towards a breakout. So there was a very strong move from Bajaj Finance and Finserv start of this calendar year where these stocks recovered, I think some 1,500, 2,000 points for Bajaj Finance and I think 300 to 400 points for Bajaj Finserv, where the stock recovered from 1,600 levels to 2,000 plus thereabouts. So after this kind of a sharp recovery over the last 1 or 2 months, the stock was just about stagnating into a trading range. But I still believe that the chart patterns are extremely bullish for these stocks. So maybe a matter of a week or so for these stocks to absorb this kind of a news flow. But post that, I would believe that this stock should be heading towards a breakout again.
Okay, lots to talk about, and let's shift focus to what's happening within the cement sector. And the channel check run by brokerage firm Antique suggests that the industry demand is likely to grow in low single digit on a year-on-year basis for the April to May period. In fact, Ashesha is here with more details. Ashesha?
Well, yes, pricing has been a concern for the cement sector for the last several quarters, and now cement companies, remember, had undertaken price hikes in the month of April this year, but most of them could not be sustained and several of them had to be rolled back in the month of June. One, of course, is because of unseasonal rainfall, but Antique believes that in the month of April and May this year, cement sector grew in single digit. This was led by heat in the month of April, which was above normal, followed by unseasonal rainfall in the month of May. Now, as far as pricing is concerned, as I mentioned, sharp hikes of about 40 rupees per bag were undertaken in the month of April, but they sustained till the end of May but had to be rolled back partially in the month of June, and we saw price decline of 10 rupees per bag in the month of June this year. So yes, partial price hikes had to be rolled back, and we had some other channel checks also suggesting the same, and now Antique channel checks also suggest a price decline in this month. Now if we look at average cement prices in the first quarter of FY26 on a quarter to date basis, they are at the highest level that we have seen in the last 18 months. On a sequential basis, they are up 3%, and on a year on year basis, they have risen by about 4 to 5%. Antique believes profitability of cement companies is likely to sustain going forward. Yes, there will be a negative operating leverage, but that will be offset by price hikes that the company had undertaken. There were rollbacks, but they were not completely rolled back, only partially rolled back, and hence realizations are likely to see an uptick in the first quarter of FY26. Of course, sustenance of these price hikes will be crucial to justify the valuations of these cement companies, but for now single digit growth is what the sector is likely to report in the first quarter. Price hikes are partially rolled back, and this is a negative for the cement sector.
Yeah, Shesha, thanks for all of those details. Well, Antique has come out with a note not only on the entire cement space, but playing on this monsoon theme, they've also come out with a note on Blue Star today, wherein they've cut the target price on Blue Star to 1,712 from 1,828 earlier. They say that June is expected to be a washout for this company on the back of early monsoons. Sandeep, what are you making of these notes coming in from Antique this morning? How do you believe that sectors that could be hampered by this early monsoon, like cement and now air conditioning too, could pan out going ahead? Because Antique believes the only trigger here could be the festive season. Otherwise, it looks pretty lackluster for companies belonging to these sectors.
Yeah, for air conditioning companies, obviously, this has been a negative development because last year growth came back after a very long period of time. And this year there was the expectation of high growth, and as such, many of these companies just stuffed the overall system, distributors, retailers with huge amount of inventory. Because the initial prediction, if you see, by the IMD was for a very severe summer, and then we had early monsoons, unseasonal rains, etc. So now we are at a scenario where there is huge inventory in the system, and there could be price cuts, etc., to push volumes. And next year's, again, the dispatches from companies could get impacted because the system is so overstocked. So I think it will be a challenging time for this segment at least. And cement also, like the companies tried to increase prices. Obviously, the monsoons made lower demand in the near term. And the valuations of most of the cement companies are very, very high, given that it's a commodity business. Many of the stock, if you see something like Ambuja Cement, it trades at some 60 times earnings. Like, it is unbelievable, the kind of earnings. So I think we need to see these stocks correct. And once the correction plays out, a normal monsoon would actually mean better longer term demand because water availability improves. So if many of these stocks actually correct during the monsoons, then it might be a good time to actually look at them at that point of time.
Sandeep, I know we were talking about this yesterday as well, and you know how this artificial ban, if you will, from China stopping the supply of rare earth magnets. But the fact that China produces 60% of rare earths and processes 90% of them, the bigger ramification is not just for automobiles, but even for, say, petroleum refining, for chemical processing, electronics, optical glass, clean energy, display screens, wastewater treatment, radiation, steel additives. But do you think the harder hit would be autos clearly?
In the near term, yes, if this issue is not resolved, because most of the companies, so I think two-wheeler companies have indicated less amount of inventory. Some of the four-wheeler companies like M&M, Maruti have indicated they still have inventory for 2 months plus. So, and it's a global thing what they have done. So they have their supply restrictions are impacting companies worldwide, not only in India. So let's see how it gets resolved, because ultimately they also need to sell. So they are not selling at all doesn't help them also in any way. So we need to see how it goes out. So let's say there's a disruption, auto production stalls, then for a month or so, maybe the auto sales or auto production could get impacted significantly. And eventually, I think the supply has to come back. So I think that's the challenge which investors have to evaluate today, that whether there'll be a disruption, if there's a disruption, how long the disruption will be for. So I think near term it creates uncertainty, and now the news flow also has become significant. Most policymakers also are becoming cognizant of this. So let's watch out whether it gets resolved or not. With China, we can never be sure what happens.
That's one sword that keeps hanging on everybody's head as in when China comes out with any new announcement in terms of their trade deals with any trading country in the world. But let's shift focus. While we are talking about some sectors, let's talk about the power sector now, because India has seen a drop in power demand in May amid early monsoons, and Kanishka is joining us with what it means for the companies and what could the impact be on their financials as well. Kanishka.
Let's take a look at what the power demand trend looked like in May. Now, India's demand showed a notable dip in the month gone by. That's falling 4.3% on a year-on-year basis, primarily due to unseasonal rains in most parts of the country and also a cooler weather. Now, peak power demand declined to 231 gigawatt. That's down from 250 gigawatt in May 2024, which is continuing a downward trend from the recent months. Now, as a result, thermal plant load factor, that is PLF, that drops to 67.9% compared to 76% a year ago. That reflects lower capacity utilization. Now, remember, despite the short-term softness, coal stock levels at power plants rose 26% on a year-on-year basis, covering nearly 19.6 days worth of coal supply, and installed capacity that stood at 472 gigawatts by the end of April. Now, that was supported by 3 gigawatts of renewable additions that month. Now remember, on the renewables front, we have clean energy share that rose 15% up from 13% last year. Solar are prices on the Indian Energy Index that dropped to 2.3 rupees kilowatt per hour, indicating supply surplus, while non-solar hour prices stayed elevated, averaging around that 6.3 rupees kilowatt per hour and spiking to 10 rupees per unit on most days. Now, on this, apart from that, while May demand has seen a slight slowdown, India's energy transition and supply buildup that continued to pick up pace in the month of May.
Okay, that's what's happening within the entire power space. But I want to check in on Reliance. The fact that it's hardly participated in the uptick of the markets that we've seen play out all through the month of April to May. But there's a bullish report coming in from the House of Jeffries talking about how growth could be back for Reliance. They're talking about the visibility on FY26 growth, which they see improving with acceleration in the retail segment for RIL. They're saying 23% EBITDA growth is what they anticipate for both Jio and near-term strength even in the O2C business. They're talking about as to how there could be the